Good. So I will list out my scope with you. I wanted to say before whether I should use another document to do the presentation. In any case, so I have some topics that I'll be taking you for the during the course of this lecture. So the first item we are going to discuss in class will be cost of capital, which is very foundational or fundamental to whatever you are going to do under this financial management. Then after that, we are going to talk about capital budgeting decision. Okay. Then three, we are going to discuss, based on my scope, we are going to discuss risk and uncertainty. Risk and uncertainty. For those of you that did performance management last diet, you have experienced capital budgeting as well as the risk and uncertainty is the same thing. All right. So which is a plus for you. No student should fail financial management. Yeah, because it's very straightforward. Then number four, I will take you portfolio theory. Portfolio theory. Then I will also take you capital asset pricing model. Asset pricing model. Okay. Which is capping. We call it capping. The number six, I will take you working capital management. Again, under performance management, you have done working capital. So these are some of the topics that were taken away from performance management and then put it in the financial management. So it's a bonus for you. Then number seven, we are going to talk about business valuation. Business valuation. Then number eight, we are going to do specific investment decision. Specific investment decision. There are two areas of specific investment decision. One is lease versus hire purchase. All right. Then the other one is asset replacement decision. So asset replacement decision will be taken by Mr. Ashewaju. Okay. So I will take you lease versus hire purchase financing. All right. So these are the scope that I will be taking you during the course of this class. So we are going to pick it one by one. I'm not going to do overview of each of them. So we go straight to the class. All right. So that will save our time and then that will send a signal to other students that lecture has commenced. So let me check from this table of contents if there is any other one that I missed. Okay, like I said, I will take you cost of capital, take you capital budgeting, risk and uncertainty, specific investment decision. Asset replacement will be taken by Mr. Ashiwaju. Capital rationale, Mr. Ashiwaju. Portfolio, I will take you. Capping, I will take you. Working capital is my scope. Business valuation is my scope. Source of finance is Mr. Ashiwaju. Theories of journey is Mr. Ashiwaju. Dividend policy, Ashiwaju, then Ashiwaju. So that is where we splitted the topics. All right. Then in the current syllabus, we could not find mathematics of finance. So pending when ICAN will release their study pack. So we need to check if mathematics of finance will be embedded in the scope of financial management. All right. So that's why we have to include it in this material. However, all the other ones are purely theoretical. Introduction to financial management, regulatory background, okay, the financial environment where you have the Nigeria financial system, all right? Then we have corporate governance. Okay, so all these ones are purely theoretical. So these are self-study topics, all right? Then, like I said, the mathematics of finance is not in the current syllabus, but it's supposed to be there because this is financial management and it's fundamental too. In fact, had it been is there, would have started with mathematics of finance before cost of capital. But like I said, when I can release the study part, we are going to confirm if it's there. If not there, that means it's not part of your the scope of FM. All right. Okay, then let the class begin. Let the class begin. So we are going to be starting with cost of capital. Cost of capital. All right. Now, what do you understand by cost of capital? Before we go there, let me tell you one or two things that you need to take into consideration as far as this diet is concerned. All right? I want to be sure you can hear me. Please say hi.
Hi.
Okay, then. Thank you. I don't want to be so that I'm not talking into the baskets. All right. So I want to be sure that I have you behind me.
Hi.
Okay. All right. Thank you, Olusoji. All right then. So before we commence the topic for today, which is cost of capital, I need to remind you of your responsibility. All right. You have taken time. You have decided that you want to write ICAN November 2025 diet. And it's important for you to take this exam that you want to write very seriously. Poco a poco. That is little by little, before you know it, November, here I come. It doesn't take time. All right. Time flies like anything. Before you wink, November is here. Therefore, guys, I want to encourage you. You have set out to achieve your ICAN goal for this diet. Your main goal is to pass all the papers that you register for. Therefore, it is important for you to take this exam that you want to write very seriously. You have taken a bold step by enrolling for class because this is one of the resources you need for you to be able to achieve your ICAN goal. One thing I can assure you is that as far as equity professional is concerned, we are going to do justice to the syllabus across all subjects because we have the capacity, we have the exposure, and we also have the experience. All right? So you have nothing to fear. The onus is on you for you to take your study very seriously. So, like I was saying, now that you have decided to start ICAN lecture for the November diet, please, on each day, you have to review your ICAN goals. Your ICAN goal for this November is for you to pass your exam. Therefore, if possible, in your class notes or in any of your books or where you can see it very clearly, you need to write it in capital letter. I want to pass my ICAN exam in November 2025 diet. So that is your goal. Your goal is to pass your exam across all the subjects that you want to register for. So the next thing is for you to get all relevant resources that will enable you to achieve that your goal. One of them is the lecture you are currently attending. Then another ones are your study materials, your textbook, and any other materials that you need that will enable you. Then you also need to study. In fact, you must have minimum of 2 hours studying per day. No matter how busy are your schedule, you need to design that. You need to schedule that. You need to design your reading timetable that will be guiding you. Of course, it is possible there may be unforeseen circumstance that will limit your capacity or your ability to study for a particular day. You must find a way of recovering it. If you miss that 2 hours per day, it will continue to accumulate. So you must find time to recover it. So if you have scheduled 2 hours for each day, Monday to Sunday, all right? So if you miss a particular day, by the time you are doing the next one, instead of you to do 2 hours, you have to extend it to 3 hours. The next one, another 3 hours. Then you have recovered the 2 hours that you missed. You just have to find a way. No matter how tight are your schedule, you look at yourself, you know when it is convenient for you to study. We are different people, different individuals. All right? Our level of assimilation differ. Therefore, you must know what works best for you. Some people can read at night, some very early in the morning, around 3 a.m., 2 a.m., or whatever. So whichever one that is more convenient for you is what you should adopt. But what is important is that you can't just be reading anyhow or randomly. You must design your reading timetable across all subjects. It is possible you may have you may read a particular subject for twice in a week, depending on how many subjects you register for. But what is important is that you just have to touch all of them on each day. That's one. Then number two, it is possible you may have friends or colleagues or neighbors that will be telling you that ICAN exam is difficult. I can bet you no exam is difficult. The onus is on you to take your study very seriously. As easy as some of the languages we did in school, but maybe Yoruba, Igbo, Hausa language that we did then, as easy as they are, some students are failing it. Even though it's your own, it's your own language, as a Yoruba person, as an Igbo person, or Hausa person, yet, why? It's because you did not take it very seriously. So there's no subject that is difficult. It's all about you. It is, some people are what we call the psycho vampire. They are the people that doesn't see any good thing about a particular thing. They will just be telling you some negative aspect of that particular subject in order to discourage you. Don't listen to such people that will be telling you like ICAN exam is difficult, is this, is that. ICAN is not difficult. If ICAN exam is difficult, those people that are winning prizes every diet, they won't win it. Those people that are clearing all their papers register for, they won't be able to pass because the exam is difficult. So you have to develop that positive or growth mindset. So anybody that is sounding negative to you, you have to withdraw yourself. You should know that this is not a good partner for my study. Please, it's very important. It's very important. No worries. As you proceed, for each lecture day, we are going to be reminding you of your responsibility because it is important that you take it very seriously. You see, like I mentioned earlier on, November is right here at hand. Before you wink, is already here. So that goal you want to achieve. Let me gist you, or let me confirm to you. The result of this November diet that we have begun, the result of this November diet will be released before Christmas, between 20th and 22 or 23 of December. So as you lay your bed, so also you will lie on it. When you are studying, you have to put the end in mind. The outcome is for you to pass your exams. So that on that day, when I can release your result before Christmas, for some of us that are Christians, that are Christians, so you must know, because if you pass your exam, it will be double joy. It will be double celebration during the period of Xmas, Christmas. But if you have reference, you are going to feel sad. You'll be dejected. Each time you remember, even when you are among your friends or neighbors or family, once you remember that, I failed this paper, you feel bad. Your mood will change. Therefore, you have to design the outcome you are going to earn on that day, whether good or bad, because you have full responsibility for the exam that you want to. That's what I'm telling you now. You have to take it very seriously. You have to start reading almost immediately. You don't wait for any lecturer to come and take you before you begin to read. Get all relevant materials and be ahead of the class. Your target should be that you want to win prize. For those of you that will be writing all for all papers, your target should be that you work as if you want to win prize. So that if you don't win the prize, there's no way you can fail it. If you don't get it 100%, you'll be close to the 100%. But if you are aiming for average, I can't keep myself. If I can just score 50%, I'm okay. If you aim for 50%, you cannot pass the exam because your effort, the effort you are going to put in will be based on 50%, not 100%. And that's such students will find themselves below 50 or less than 30 in some cases. Please take it very seriously. May God Almighty make it very easy for you. So that's enough for today. So let's begin the class. All right. So we are going to be discussing cost of capital today. Let me see. Okay. I'm thinking, should I even use, okay, let me look for a space. Allow me to click now. All right. Aziz, you are the one writing something on my screen. Okay. Sorry, let me distance. Oh, please give me 1 minute. My pen is not connected because I break for a while. I didn't use it, so I have to close this and restart again. Just give me 1 minute, please. I'll get back to you. Hey, you can imagine, you would have missed so much. Thank you for reminding me. All right. So we are going to discuss under categories of cost of capital. We talk about traditional weighted average cost of capital. We talk about projects specific cost of capital. Then finally, we are going to discuss weighted average cost of capital of combined activity. I call it WACOCA, all right? I call it WACOCA, weighted average cost of capital of combined activity. When we get there, I will explain it to you in details. All right then, so let's start one after the other. What do you understand by cost of capital? Before I give you the definition of cost of capital, let me just give you a kind of explanation so that you understand where we are driving at. I mean, what we are driving at. Now, when you talk about cost of capital, as the name implied, it's a cost and it's a company that is paying it. When you say a company, that means company has owner or owners. There are some people that set up the business. Those are the shareholders. Now, the shareholders have contributed their capital to finance the operation of the business, to set up the company with the expectation that they are going to earn a return on their investment when the company does well. Excuse me. My speaker, my default, I was trying to, okay, yeah. So please let me know, can you hear me?
Yes. Yes, we can hear
Okay,
you.
Yes, sir.
I
Yes,
receive
sir. We
I
can hear
receive a
you.
mess. Okay, thank you. I receive a message that my speaker has changed. Okay, my speaker has changed to market. No, that's not what I want. Let me use the that's what has changed. Yes, that's what I want. Okay, let's just continue. All right. So the owners of the business are expecting a return on their investment at the end of the period when the company does well in the market. That is, when the company makes profits. So they are going to pay dividend to the shareholders. So the dividend that the company will pay to the shareholders is a cash outflow because the dividend will be paid out of the profit of the company. You know, in the profit or loss accounts, the top line item is revenue. From revenue, you charge the direct cost, the cost of goods sold. You have your gross profits. From gross profits, you are going to less the operating expenses. You have your profit before interest and tax. Then you charge interest expense. You have your profit before tax. You charge tax expense. Then you have your profit after tax. From the profit after tax, the company will need to pay dividend to the owners of the business. All right. So the dividend that the company will pay to the shareholders is to the shareholders is a return on their investment, but to the company that is paying it is a cost to them. Not only that, it is also possible that the company may want to embark on a project and the finance required is not sufficient or is not readily available. So in this case, the company will need to approach a lender, for example, a bank that, please, I need 100 million naira for a project and I intend to pay back within so period. The money that the company wants to borrow is not for free. If the bank is going to borrow the company the loan, of course, it will come with interest. It will come with interest. So the interest that the company will pay to the bank or to the lender or investor is also a cost to the company because the cash will be going out. When you want to pay the interest expense, cash will be going out. It's a cash outflow. But the lender or the debt holder that will receive the interest is a return on their investment. The same thing with preference shareholders. Now, all these providers of capital, they have contributed money to finance the operation of the business. So, and they are expecting a return on their investment. So that return on their investments that the providers of capital will receive is a cost to the company because it's a cash outflow. That is what we call cost of capital. Now, if you want to define cost of capital, you will say cost of capital represents the compensation required by the providers of capital, including the ordinary shareholders, debt holders, and preference shareholders from their investment in a company. I take it again. Cost of capital represents the compensation required by the providers of capital or suppliers of capital from their investments in a company. When you talk about suppliers of capital or providers of capital, they are equity holders, debt holders, as well as preference shareholders. Because those categories of investors, they have contributed their money to finance the operation of the business and they are expecting a return on their investment. The return on their investment represents compensation. The company will compensate those providers of capital for investing their money in the company. All right, that is basically what cost of capital is all about. The cost of capital is determined by the market forces of demand and supply. depending on the perceived risk associated with the company. I take it again. Cost of capital is determined by the market forces of demand and supply, depending on the perceived risk associated with a company, which means that the higher the perceived risk, the higher the cost of capital, and vice versa. If the providers of capital think that the company is too risky for them to invest their money, then if at all they invest, the cost, the return that the company will pay, okay, will pay to those providers of capital will be very high. But if the risk associated with the company is low, then the return, the cost that the company will pay will also be low. All right. So that is, and in this case, the company will need to create sufficient return. The company will need to create sufficient return that will cover the cost in order to create value. Company will be able to create value if the company is able to generate profits, because it is from the profits you are going to settle the shareholders. The primary responsibility of every business is to create value for shareholders. If you are unable to create value as a management of a company, that means you are not fit for purpose. All right? You must be able to create value at all time, no matter how little. All right? So that is the introduction to cost of capital. Let's talk about importance of cost of capital. Importance of cost of capital. I will not rush you. So being the first day lecture, so let's take it slow and steady. Importance of cost of capital. Basically, there are two key importance of cost of capital. One is determining, or let's start with investment appraiser. Okay. One, project evaluation. Project evaluation, I will explain. Then two, we have determining debt equity proportion. Debt equity proportion. Okay, let me explain each of them. You recall earlier when I was telling you about cost of capital. Cost of capital is foundational, is fundamental to almost all the topics in financial management. There's hardly any quantitative you want to do, any calculation you want to do in cost of in financial management that you are not going to need cost of capital. All right. Now, when you talk about importance of cost of capital, one key significance of cost of capital is project evaluation. What do you mean by project evaluation? When a company wants to embark on a project, or when a company wants to execute a project, it is important to determine the financial viability of the project before the company commits its limited scarce financial resources into the project. So you want to know whether the project is financially viable, whether you should invest in the project. So cost of capital is needed to discount the future cash flow to the present value equivalent using relevant investment appraisal technique like NPV, IRR, okay, IRR, project adjusted present value. All right. So you need cost of capital to discount the future cash flows. So that is one of the importance of cost of capital. The second one is determining debt equity proportion. In the company capital structure, the capital structure is the way and manner a company finances its operation. Okay. Generally, company finance sources of long-term financing include the equity. Please, if I'm too fast, let me know. Equity, which you know as ordinary share capital. Then, of course, debt capital. Okay, debt capital. Then you also have preference share capital. All right. So these are the three sources of long-term financing. So when you talk about capital structure, I said it's the way and manner a company finances its operation. All right. So each source of finance has its own underlying cost. Like I already explained to you, for ordinary share capital, the company will pay dividend to the shareholders. The company, for the debt capital, the company will pay interest expense to the debt holders. For the preference share capital, the company will pay a preference fixed dividend, okay, fixed dividend to the preference shareholders. So all those, the dividend, the interest are a cost to the company. So each source of finance in the company's capital structure has its own underlying cost. Therefore, the company will need to determine the debt equity proportion. That is, what is the percentage of debt? What's the percentage of equity as you carry in the balance sheet, that is in the capital structure, for me to be able to minimize the overall cost of capital? So because since each source of finance has its own underlying cost, and of course, one of the objectives of a company is to minimize its cost minimization. You want to minimize the overall cost of capital. Therefore, you must know, should I invest 60% in equity and 40% of debt, or should I do 70% of debt, 30% of equity? The underlying cost of each source of finance will determine how much of them you need to carry in your balance sheet. So cost of capital is used in determining the debt equity proportion in a company's capital structure. I believe that is clear. So that is as per the importance of cost of capital. The next item we are going to discuss is categories of cost of capital. Before we go into that, let me know if you have any question for me, please. Talk to me. Any question for me so far? Okay. If there is none,
yes, sir. Sorry, please.
Yes, talk to me.
The last statement you made about cost of capital, you said it is used to determine. Please, I did not get that.
You mean for the debt equity proportion? Talk to me. Is it for the debt equity proportion? The statement I made on the debt equity proportion.
Sorry, I'm not sure, but I just know that is the last statement that so cost of capital is used to determine.
I
So
said
I was
cost of
trying to.
capital is used to determine the debt equity proportion in a company's capital structure.
Okay, thank you.
Cost of capital is used to determine the debt equity proportion in a company's capital structure. That was the last statement I made. All right. So let's talk about categories of cost of capital. Or do you still have other questions for me?
No, sir.
Okay, then. So let's move on. Now, you have to be very careful. And that's why I have to list all of this into three. On the day of your exam, you are not going to be told to calculate cost of capital or to calculate traditional work, project specific, except if you are lucky, examiner can just tell you to calculate a project specific cost of capital, especially at this level, skills level. All right. So, but you must know what are the variables you should look out for in the question for you to know you are supposed to calculate traditional work, project specific work, or work of the combined activity. All right. So all of them I'm going to explain it to you under this topic. So where we have major work, is the categories of cost of capital. So let's take it one by one. Now, as shown in the outline under cost of capital, there are three categories of cost of capital, which is traditional WACC, project-specific WACC, and then WACC of the combined activity. So let's talk about traditional weighted average cost of capital. All right? Let's talk about traditional weighted average cost of capital. Okay. In the determination of traditional WACC, the following procedures should be considered whenever you want to calculate traditional WACC. You must follow the following step. You must follow the steps below. Number one, you calculate. Okay, calculate cost of equity. Okay, this is a given because as a company, you must have a company. We have owners. If the company has owner, then the company must pay dividend to the shareholders. So as a company, there must be cost of equity. Then number two, you go to the balance sheet under the finance by, that's the capital structure. Identify if you can see preference share capital. If the company has preference share capital in the balance sheet, then you need to calculate cost of preference share. Calculate cost of preference share. KP. Also, it is possible that the company must have financed its operation with debt capital, either through bond, debenture, or loan note, or even bank loan. So you need to calculate cost of debt. So calculate cost of debt. Cost of debt, which is a KD. Then finally, you need to estimate. All right, you estimate weighted average cost of capital. Weighted average cost of capital. That is WACC. So these are the four procedures you are going to carry out anytime you want to calculate traditional WACC. Now, when do you calculate traditional WACC? I'm going to be explaining each of them. This topic will take us for the next 5 months, sorry, for the next 5 weeks. All right. So it will take you for the next 5 weeks or 5 periods. That is the minimum. It's not something I will rush you. Like I said, it's very fundamental. All right. So it's step by step. Okay, then. Now, when do you use traditional WACC? Especially at this level, well, it is possible examiner may tell you to calculate WACC, but you may not be told. It's not there in your syllabus. An examiner will tell you use the traditional WACC. They will just tell you calculate WACC. So how do you know that you are supposed to calculate traditional WACC? All right. So traditional WACC. Okay, let me just put it down for you. When to calculate? When to calculate traditional WACC? Excuse me. Because each of the categories of cost of capital, they are WACC. The traditional WACC, the project-specific WACC, the WACC, the three of them are WACC. So you must know which of them are you supposed to calculate for. And that's what I want to explain to you, what you need to do under each. How do you know you are supposed to calculate traditional work? How do you know you are supposed to calculate project specific? All right. So, because this is very key so that you don't miss it. Okay, then. Now, this will be computed. This will be computed when information on capital structure, including ordinary share capital, preference share capital, or debt capital and their underlying costs are given. Okay. So if in the question you are given information, you are given balance sheets. In the balance sheets, you can see ordinary share capital, preference share capital. Then you need nobody to tell you that you are supposed to calculate traditional WACC, because project-specific cost of capital does not consider itself or does not concern itself with a balance sheet information. You don't need all of those things to calculate your project-specific WACC. The same thing with WACOCA. There are different things you are going to look out for in a question for you to be able to use those ones. But if in a question, examiner has given information on balance sheet, the information on the capital structure, like ordinary share capital, debt capital, preference share capital, including their cost, like, for example, you are given dividend, you are given interest in the question, then certainly it is traditional work you are going to calculate. So that is one, it is only when you are given the capital structural information that you use the traditional work. Other than that, it will be something else. When we get there, I will also explain. I believe that is clear. Now, let's talk about when you now want to calculate the cost of capital. I've told you there are 4 procedures that you are going to carry out. The first step is to calculate cost of equity. Step 2, you calculate cost of preference share. Step 3, you determine the cost of debt. Then step 4, you estimate the weighted average cost of capital. So I'm going to be explaining each of them, each procedure for calculating work. I'll be explaining it to you one after the other. So let's start with cost of equity. Cost of equity. What do you understand by cost of equity? All right. What is cost of equity? What are the methods of calculating cost of equity? All right. Then how do you estimate the cost of equity using all the methods, all the available methods? Those are the things we want to be discussing now. But first thing first, you need to understand what is cost of equity. You recall the other time, I mentioned to you that the shareholders has contributed their money to finance the operation of the company, and they are expecting a return on their investments. The return that the shareholders will earn from their investment in the company is the cost of equity. To the company, it is called cost of equity because it is paid to the ordinary shareholders. But to the shareholders that will receive it is a return on their investment. Therefore, you can say that cost of equity represents, let me put it down, this represents the compensation, this represents the minimum rate of return. Let me rewrite it. This represents the minimum required rate of return expected by the ordinary shareholders, or you can call it ordinary shareholders or equity holders. It's the same thing. Expected by the ordinary shareholders from their investments in the company. Okay, so the dividend the company paid to the ordinary shareholders. So it's a return on their investment. Okay, it is also known as opportunity cost of capital. It is also known as the opportunity cost of capital because the owners of the business would have committed their funds or capital in other venture, but if they decide to invest it in the company, that means they have forgone the benefit that could have accrued to them from other business activities. All right, so it's a cost. It's an opportunity cost of capital. It's a benefit forgone as a result of investing in the company. Okay, so that is the meaning of cost of equity. Now, what are the methods of calculating cost of equity? Methods. Basically, there are three methods of calculating cost of equity. One is dividend valuation model. Okay. Two, capital assets pricing model. Capital asset pricing model. Capping. Then three, we have Miller and Modigliani, M&M. Okay, Mr. Shiwaju, we talk more on the Miller and Modigliani when he's taking you theories of journey, capital structure, all right? So these are the three methods of calculating cost of equity. You see the way we are taking it step by step, so you don't jump. That's what I said. That's what I told you that it will take us some time. It will take over a month for us to be able to complete cost of capital because it's pregnant. The topic is pregnant. Now let's talk about dividend valuation model. Dividend valuation model. So I said that there are three methods of calculating cost of equity. One of them is dividend valuation model. Therefore, what do you mean by dividend valuation model? The dividend valuation model or cost of capital or cost of equity. Cost of equity using dividend. Let me use acronyms. Using dividend valuation model. What's wrong with you? Using dividend valuation model is calculated as the ratio of dividend to share price. So whenever you want to calculate cost of equity and you see if information on dividend are given to you, you should know that you are supposed to use dividend valuation model. Okay, let me just put it down for you. You are my baby, so I need to treat you like one. If you are a professional, SFN, so I won't do all of that. But it is expected that you should know it. But as my baby, I will come down so that you understand it. Because I don't want to struggle when you get to professional under, I don't want you to struggle when you get to professional under strategic financial management. Because when you get to, you are still going to do the same thing under strategic financial management, but in a more, all this concept I'm explaining is the same thing, but your question may be maybe advanced. All right. So it's better for me to take my time to explain to you now, understand the basics, so that when I'm talking to you under strategic financial management, you understand it better. All right. Before I say B, you already know where I'm going. Yeah. So that's why it is important for me to break it down for you so that you don't struggle. Okay, then. When do you use dividend valuation model? Let me put it down for you. The dividend valuation model is used when information on dividend is given. So if in the question, you can see dividend, you can see share price, all right? Then you don't need anybody to tell you that you are supposed to calculate cost of equity using dividend valuation model. At times, you may be lucky, examiner may mention it to you that, oh, calculate cost of equity using dividend valuation model. You may be lucky. But what if you are not told? How would you know you are supposed to use dividend valuation model? That's what I just mentioned it to you. When you see information on dividend, okay, when you see information on dividend in the question, then you need nobody to tell you that you are supposed to calculate cost of equity using dividend valuation model. Now, how do you then calculate it? How do you calculate cost of equity using dividend valuation model? Remember, I said is the ratio of dividend to share price. So you then say this can be calculated. This can be calculated as follows. Depending on whether, let me write it. Depending on whether or not, there is growth in dividend payments. All right. Okay. So let me now show you. Number A, where there is no growth, in dividend. So if there is no growth in dividend, it means that dividend is constant to perpetuity. Okay. So if dividend is constant, then cost of equity will be calculated as the ratio of dividend to ex-div share price. So you pick your current dividend. Current dividend is the same thing as DO. All right. Then divided by ex-div share price multiplied by 100%. You see, I like to use ex-div share price as my denominator instead of just share price. The reason being that if you put ex-div share price, it will draw your attention to go to the question and check if dividend has been paid. Because if dividend has not been paid, you cannot use the share price given to you. because the share price to be used must be the one that exclude share price, that exclude the dividend. So if you are given a share price that include dividend, you need to convert it to ex-div share price. I will explain it to you later on. So I like to use ex-div share price as my denominator instead of just say share price, or I will just put P, which is price. All right. So this is the formula you are going to use to calculate cost of equity where there is no growth in dividend payment. Yes, Olarin, why you talk to me?
Sir, what that X dividend share price, that EX, what does it qualify, sir?
Excluding dividend.
Excluding, okay.
Yes. The
Thank you,
share
sir.
price that is, I will explain to you later on what ex-div share price is. All right. Now, under where there is no growth, it is also possible that examiner may want you to calculate market value of equity. So where there is no growth, if you are now asked to calculate market value of equity, then in this case, this ex-div share price you are seeing here is the market value of equity per share. So if your examiner is asking you to calculate market value of equity, all you need to do is to just cross multiply the formula for cost of equity. You cross multiply it to get the market value of equity. Therefore, market value of equity represents the present value of future cash flows, that is dividend, discounted at the cost of equity or discounted at dividend yield. Okay, so that is the market value of, I will explain to you when we get to valuation, business valuation. All right, but for now, so let's take it slow and steady. Okay then. So like I said, you cross multiply. I would then say market value of equity equal to current dividend divided by cost of equity. That's it. You can call it cost of equity or dividend yield. All right. Or rate of return on equity. Whatever you want to call it is the same thing. So this is the formula for calculating cost of equity. This is the formula for calculating market value of equity where there is no growth. The second one, where there is growth, where there is growth in dividend payments. How do you calculate the cost of equity? Let me show you. Cost of equity will be calculated as the current dividend, which is DO. You recall that I've denoted the current dividend as DO here. So watch out. So because there's growth in dividend payments, so you are going to pick the current dividend, you multiply with the 1 plus the growth rates, then divided by ex-div, share price, plus the growth. All of this multiplied by 100%. So where there's growth in dividend payments, this is the formula that you are going to use on the day of your exam. If you have question under cost of equity, this will be the likely formula that you are going to use. All right? That's the likely formula that you are going to use. Now, it is possible you may also be asked to calculate market value of equity where there's growth in dividend payments. So in this case, market value of equity will be computed as the current dividend multiplied by 1 plus the growth rates, all divided by cost of equity minus the growth rate. All right. So of course, when you talk about market value of equity, it will be in Naira. When you talk about cost of equity, we said it's a rate of return, so it will be in percentage. So watch out. All right. So these are the two formulas that you can use to calculate cost of equity as well as the market value of equity using dividend valuation model. All right, so that is as per that. Now, before we talk about growth rates, how to estimate growth rates, you need to understand what is cum-div share price, what is ex-div share price. So that's the next thing we want to talk about. So let me hear from you. If you have any question for me, talk to me. Any question for me so far? Raise your hand. So let's talk about it.
Please, sir, can you recap on the last formula you just stated?
The last formula, the market value.
Yes.
I said this market value of equity, this formula is used when you are given growth rate in the question and you are asked to calculate market value of equity. So two things will occur here. It is possible that the growth rates may not be given to you. You may be the one to estimate the growth rates. How do you estimate it? And I said I will show you later on. All right, but the most important thing is that first thing first, you need to understand what is ex-div share price, what is cum-div share price. That is the concept I want to explain to you. So this particular formula, this formula will be used to calculate cost of equity when you are given, when dividend is when dividend is growing. What do I mean by dividend is growing or there's growth in dividend payments? Say, for example, you have year 1, year 2, year 3. The dividend paid, the dividend in the first year, let's say, is 10 naira. In the second year, it has increased to 12 naira. In the third year, it has increased to 15 naira. So since dividend is not the same thing for across the 3 years, it means that there's growth in dividend payments. So in some cases, examiner will not give to you the growth rates. It is implied in the question. It is expected that you know it. So once you see that the dividend given to you for respective years are different, it means that there is growth in dividend payment. Therefore, you need to go and estimate the growth rate first before you come and calculate your cost of equity. But if in the question, in the year 1, you are given a dividend of 10 naira, year 2, 10 naira, year 3, 10 naira, it means that there is no growth in dividend. Dividend is constant. So if dividend is constant, you use the first formula. You use this one. But if dividend is different for each year, then you are going to use the formula with the growth rate. So that is for that. Is it clear now?
Yes, sir.
Okay, then. So let's move on.
Yes, sir, please, I want to confirm something.
Talk to me.
Okay, so is it that whenever we are calculating this cost of equity, we are supposed to calculate this market value of equity?
No, you only calculate it if your examiner asks you. I only put the formula there for you to for information's sake. Ordinarily, you only do this when we get to valuation. It's a topic on its own. All right?
Thank you, sir.
You are welcome. Well, at times, the examiner can combine the two. It may be has to calculate cost of equity and then calculate market value of equity. All right? So, yeah. So let's talk about ex-div share price. Talk to me.
Okay, so is
Like
it possible that the growth rates would be different for different years?
Pardon?
Is it possible to have different growth rates?
You
Is that
are
possible?
calculating growth rates. You are calculating growth rates for the years given to you. You want to know what has changed. Like I explained the other time, you have year 1, year 2, year 3. You can't calculate growth rate for 1 year. If it's 1 year, there is no growth now, it's the same amount. So, but if the value has changed, for example, here you have 20, here you have 25, Here you have 26. You can see the value has increased from 20 to 26. So what has changed? What is the growth?
Okay.
That's what you need to. So if it's for only one, you can't calculate growth rate for 1 year. If it's for 1 year, there's nothing like growth. It has not changed. Do you understand?
Yes, thank you.
You're welcome. So let's talk about XDiv and CumDiv. Share price. You need to understand this. So what do you mean by XDiv share price? XDiv share price. The XDiv share price represents the share price that include dividends. This represents the share price that exclude dividends. So in the calculation of cost of equity, only the dividend, or let me put it this way. In the calculation of cost of equity, only XDiv share price is used. Only XDiv, let me put it there. X share price is used. Therefore, what's wrong with you? Therefore, if CumDiv share price is given, it should be converted to XDiv share price before calculating cost of equity. Okay. So for this purpose, the XDiv share price, XDiv share price is calculated as CumDiv share price minus the current dividend. Okay, so what I'm trying to explain here is that on the day of your examiner may tell you that the company finance, the project, the company is financed with 1,000 shares. Is financed with 1,000 shares of 1 naira each, quoted at 50 kobo, CumDiv. So once you can hear CumDiv in the question, it means that the dividend has not been paid. Or examiner can also tell you, examiner may not call it CumDiv share price. You may be told that the share price is 5 naira. The dividend is here to be paid. Because dividend is here to be paid, it means that that 5 naira is CumDiv. Examiner can also say that, oh, the dividend is still outstanding, or the dividend is here to be paid, or the dividend will be paid in the following year. So once the dividend is still outstanding, once the dividend has not been paid, it means that the share price given to you is CumDiv share price. And you have to convert it to XDiv share price. So I just demonstrated for you how to convert CumDiv to XDiv share price. So let's talk about CumDiv. I've already talked about it, but let me just explain it. Cum div, share price. This is the share price that includes dividends. Okay? This is the share price that includes dividends. It should be noted that the cum div share price is not used. It's not used for calculating cost of equity, or should not be used for calculating cost of equity. You don't use cum div share price for calculating cost of equity. It has to be ex div share price. So if cum div is given to you, you need to convert it to ex div share price. I've already shown you how to do that. Okay, so that is for that. In most cases, cum div share price will be given to you because examiner wants you to, because it's a concept under cost of capital or other cost of equity is a cost to understand. So once you discover that dividend has not been paid in the question, it means that the share price given to you is cum div. All right. So all you need to do is to now convert the cum div to ex div. So that's the formula that you are supposed to use to do that. Okay. Now, that is as per cum div and then ex div. The last area we are going to touch under cost of equity is growth rate. Growth rate, estimating growth rate. How do you calculate growth rates? It's a concept. So after this, then we have illustration. Once I'm done with explaining this, we are going to stop the class for today. So in our next class, we have a short examples. All right. Then we move to cost of preference share. So estimating growth rates. G. Recall earlier on when I was calculating cost of equity where there is growth. This G here, the G you are seeing in this formula, on the day of your exam, you may not be given. Therefore, how do you estimate the growth rate? How do you estimate the growth rate? That's what I want to show you now. So you can see the way we are taking it one after the other. So you must understand them. All these concepts, you need to understand and digest it and allow it to sink into your memory. Because if you don't understand the fundamentals, if you don't understand the underlying concepts, you are going to struggle. Don't cram. You don't need to cram. Just understand the basics and you'll be fine. Move on. Estimating growth rate. So that growth rate, the G that you have in the formula, how do you calculate it in case you are not given? Ordinarily, the shareholders will expect that the dividend received for each year increase over time. No shareholders will expect that the dividend will remain the same. The dividend you receive in year one is the same thing you receive in year two, and on like that. That means it's even it's a measure of the fact that the company is not really doing well, because you can't be giving me the same amount of dividend every year and expect me to be happy as a shareholder. It is expected that dividend will increase, will grow over time, because you need to factor in the purchasing power of money. If I receive dividend of 10 naira per share last year, you want to be given the same dividend amount of dividend of 10 naira in 2025. What about the inflation? All right. So you need to factor in the purchasing power of the money last year versus this year. But if the dividend is growing, it's increasing every year, shareholders will be happy. I want to do more. I want to invest more in the business. But if the dividend is constant, it's not growing as expected, then I need to put my investment in other business venture that will be more profitable. Because as a shareholder, the only return I get from the business is dividend. It's true dividend. And then capital appreciation. Therefore, if dividend is increasing every year, I'll be very happy. I'll be very happy. You can see, for example, Femi Otedola, recently he invested more in the first bank shares. All right, because the company is there, he is the chairman, the company is doing well, and he has to commit more funds into the business so that he can hear more. He can hear more. You will see that in the news almost every quarter or thereabouts. Dangote is earning so billions of naira in dividend because of high level of investment he has made in those companies in the Dangote groups. All right. So if dividend is growing, shareholders will be happy. You want to do more, you want to commit more. So let's move on. How do you estimate growth rates? Basically, there are two methods of calculating growth rates. Oh, this thing has stopped again. Okay. Oh, the pen is not connecting it because I pause. I did not write on the board. I mean on the screen. I don't want to restart again, man. I don't know. It's not connecting at all. Guys, do you want me to, can you give me like a few minutes? My pen is not connecting. I need to restart so that it can connect. Can you please give me few minutes? Should I?
Okay, sir.
All right, sir.
Yes, sir.
All right, thank you. I just want to complete this growth so that like I mentioned, there are two methods of calculating growth rates. Okay, methods of calculating growth. One is historical pattern of dividend payments. Historical pattern of dividend payments. Then two, we have Gordon growth. Gordon growth model. All right, Gordon growth model. So let's pick it one by one. Historical pattern. Okay, dividend payments. When do you use historical pattern of dividend payment to calculate calculate growth rates? Let me show you. This is also known as averaging method. Averaging method. The historical pattern of dividend payments the historical pattern or the averaging method, the historical pattern of dividend payments is used when the history of dividend paid is given. All right, when the history of dividend paid for the respective years, are given. Okay, so if examiner has shown you in the question, you can see dividend paid for the first year. You are given information on dividend paid, the amount of dividend paid for the second year, the third year, the fourth year. So you are given the dividend paid across the relevant years. It means that you are going to use the historical pattern of dividend payment to compute your growth rates. So under this method, there are two different formulas that you can use. All right, under averaging method, there are two different formulas depending on the way the question is structured. Now, let me just put it there. This can be calculated using the formula below. This can be calculated using the formula below. Okay. There are two different formulas, like I said. So using historical pattern, growth rate is computed as number of years dividend is paid minus 1 into square root of latest dividend divided by dividend paid in the first year, or minus 1. Okay, so this is the formula. This is one formula. When do you use this formula to calculate growth rates? This formula will be used if the history of dividend paid or if the history of dividend payments across all relevant years are given. That is when you use this particular formula. You are given information, say for example, okay, let me put it this way. This is used when the amount of dividend paid for all the years are given. So when you are given the dividend paid across all relevant years, then you are supposed to use this formula. Say for example, let me put it, for example, so you are given dividend for, let's say, for simplicity, let's do for year 1 to 3. You are given dividend for year 1, year 2, then year 3. The amount of the dividend paid for year 1 is 10 naira. Year 2 is 13 naira. Year 3 is 15 naira. So these are the amounts of dividend paid across the 3 years. So you can see that dividend has grown has increased from 10 naira to 15 naira. What is the percentage increase? From 10 naira to 15 naira, what's the percentage increase? That's the growth that you want to estimate. So in this case, using this formula, I would then say G equal to my N. N is number of year. Okay, let me first of all explain the variable. Where N equal to number of years dividend is paid. LD, latest or current dividend. Then BD, dividend paid in the first year. Dividend paid in the first year. I want this one to be different. Dividend paid in the first year, or you can call it base year dividend. Base year dividend. Okay, that's the BD. Of course, G is the growth. Now, let's say, for example, you are given this information on dividend and you are now asked to calculate growth rates. Okay, you are now asked to calculate growth rates. Using this formula, I would then say G is equal to N from the formula. N is equal to 3 because I have year 1, year 2, year 3. So number of years is 3. Therefore, I would then say 3 minus 1 into square roots LD. LD means current year dividend. LD means current year dividend. The current year is year 3. Year 3 is the latest year. Therefore, I would then say dividend paid in year 3 is 15 naira divided by BD. BD means dividend paid in the first year or base year dividend. So dividend paid in the first year is 10 naira, or minus 1. So mathematically, I will get my answer. Whatever I have thereafter will represent my growth rate. If you are not good in using second function in your calculator, so you can just convert this one. I can say G is equal to 15 divided by 10. That should give me 1.5. I will say 1.5 raised to power 3 minus 1 is 2. So raised to power 1 over 2 raised to power 1 over 2, or minus 1. So I will get my answer, whatever it is that I get in my calculator. That's my answer. All right. So this is how to calculate growth rate. So you use this particular formula if the history of dividend paid across all relevant years are given to you, like in this case. Now, the second formula, alternatively, G is calculated as N into current dividend divided by dividend paid in the first year, or minus 1. You can see that the first formula and the second one is closely related. It's almost the same thing. The only difference is that in the first one, in the square roots, you have N minus 1. But in this second one, there is no minus 1. It's just N. That's the difference between the two. Therefore, when do you use this second formula? This is used, okay? This is used. This is used when the dividend paid, in the first year, in the first and current year are given. Okay, so that is when you use the second formula. I hope you are getting it the way I'm dishing it out, because you must understand the basics. You must know what to do. You must know the formula to use. Now, one thing that I've not told you is that as far as FM is concerned, you see, if you cannot memorize formula, you can't do much. You cannot achieve much in FM. you must be ready and willing to memorize as many formulas as possible, because on the day of your exam, only few formulas will be given to you at the back of your question paper. God help you. Most of the formula may be useless. The formula given at the back of your question paper may not be relevant to the question that you want to calculate. And that's why it is important for you to memorize all the formulas. So that whichever one examiner is testing you on, so you'll be able to do justice to it. So that is basically that. Now, in this, say for example, it's the same letter. I've already defined the variables N, LD, then BD. I've defined that. So for example, you may be told that the dividend paid in the first year, the dividend paid 5 years ago, the dividend paid 5 years ago is 10 naira. Is 10 naira. Why the current dividend? Why the current dividend is 8 naira. You can see this is the information that will be given to you. The dividend paid in the first year has been given to you as 10 naira. Sorry, this one is, I said that one is 10 naira. This one should be higher. This one is, let's say this one is 15 naira. All right. So dividend paid in the first year, which is 5 years ago, is 10 naira. Dividend in the current year is 15 naira. So these are the two information that will be given to you. In this case now, when you now want to calculate your growth rate, just say G equal to N is 5. Because 5 years ago, that is the history. That's the history of dividend paid 5 years ago. All right. So I would then say 5 into square root. Latest dividend, which is the current year dividend, is 15. Dividend paid 5 years ago is 10 naira, or minus 1. Okay. So this, I will get my answer. Just say whatever you have, 15 divided by 10, which is 1.5. 5 square root 1.5 minus 1, you get your answer. If you want to, if you can't use second function, then you can say G is equal to 1.5 raised to power 1 over 5. Okay, raised to power 1 over 5. All right, or minus 1. So you get your answer. That's it. Okay, so that's whatever you have will be your. So this is how to calculate growth rate using averaging method or historical pattern of dividend payment. Let me know if you have any question on this before I do the last one, and that's where we are going to stop. All right. Any questions so far? Okay. I wanted to stop by 10:30 before, but let me see. Okay, let me quickly, within the next few minutes, let's do the last one so that I can release you. The second method, which is B, Gordon growth. Gordon growth model. This is used to calculate growth rates when information or when earnings and capital structure and the capital employed, rather, and capital employed information are given. So you use Gordon growth. If you can see earnings per share or just earnings and capital employed in the question, and you're asked to calculate growth rate, then you should know that you are supposed to use Gordon growth. You see, the way I told you on what you should look out for under historical pattern. So I'm now showing you again what you should look out for under the Gordon growth. Okay, once you can see the information on earnings and the capital employed, then you should know that you are supposed to calculate growth rates using the Gordon growth model. So how do you then calculate growth rates under Gordon growth? Growth is calculated as return on capital employed multiplied by retention rates. Let me define it. Where R equal to, let me give space. Where R equal to return on capital employed or return on investments. Return on investments. Then B equal to retention rates. All right. So whenever you want to calculate growth rates using Gordon growth, you need to first of all go and calculate return on capital employed as well as the retention rate. So whatever you have thereafter, just multiply the two together. So how do you then calculate the return on capital employed? R is calculated as earnings. Please note, earnings is the same thing as profit after tax. When you say earnings, it's the same thing as your profit after tax. So you see that information in the profit or loss account, then divided by capital employed. Mr. Ashiwaju will teach you financial statement analysis, including ratio. So we will talk more about return on capital employed under our primary ratio, okay? So we'll talk more on that. Of course, multiply by 100%. So this will give me return on capital employed. Okay. At times, capital employed, of course, capital employed can be defined in several ways. It could be total asset, it could be net assets, it could be equity plus debt. All right. But whatever the case may be, the information will be there in the question for you to do justice to it. But at times, examiner can just give it to you straight, capital employed. All right. But if capital employed is not given to you, then you are supposed to use opening shareholders fund. Alternatively, let me give it to you. Alternatively, R can be calculated as earnings divided by opening shareholders fund. Shareholders fund. All right. Multiply by 100 over 1. So that is as per that. Then how do you compute the retention rate? B equal to retention rates. So retention rate can be calculated in several ways depending on the information available. If you are given earnings in the question, then I can say retention is earnings minus dividend over earnings. multiply by 100 over 1. So when you say retention, we are saying that from the profit after tax in the profit or loss account, in the income statement, the profit after tax that the company has achieved in the income statement, part of it will be paid out as dividend. The balance will be retained in the business for growth and expansion. All right, the balance of it will be retained in the business for growth and expansion. So that retention, the portion that you retain in the business is the retention rate. So that's, you want to calculate the percentage of the earnings retained in the business. That's the retention rate. So to get that, you less dividend from the earnings, from the profit after tax. You divide it by the profit after tax. Whatever you multiply with 100%, that will give you the percentage. So if it is also possible, you may be given any per share. So if you are given earnings per share and you want to calculate the retention rate, so it will be earnings per share minus dividend per share over earnings per share multiplied by 100 over 1. Okay. So these are some of the formulas that you can use to calculate the retention rate. You can also calculate retention rate by saying 1 minus dividend payout ratio. So 1 minus dividend payout ratio will give you the retention rate. Okay, so that is basically that. So these are the concepts you need to take into consideration under cost of capital. Let me switch to the material. Let me stop sharing this and switch to the material. We're almost done. Just 1 minute. We're done. Let me, so that I want to ensure that I'm not missing anything. Okay, cost of capital is on page 36. Let me say 37. Okay. So we have talked about this. So when you have your material, when this material is shared with you, please ensure you go through all of those things I've discussed with you earlier today. So you get additional information there. I just want to be sure that I've covered so far. Okay. All right. So we have discussed all of this. Now we stop at, yeah, I think that's it. So that's it. This is where we are going to call it a day. Let me hear from you, please. Do you have any question for me? Any question? I can see some of you have disappeared. Mary Queen is still on.
Yes, sir.
Abu,
Have something.
yes, Mary Queen, talk to me.
Okay, sir. Sorry, mine is just an appeal.
Talk to me.
Yes, sir. Please, this video should be posted on time so that we can go back to it when we are practicing.
Okay, so
Yes.
what I will do is that by the grace of God, what I will do is that because ordinarily, this is raw. There are at times some students do join the class before the lecturer will come in, and the video will just be recording. So it now means you just have empty recording, nothing is happening. So you need to cut it out before you can upload it on the YouTube. But I know what I will do is that I will tell the admin to help me share the raw video of this with you. So the refined one will then be shared, will be uploaded on the YouTube so that you can quickly have access to it.
Okay, sir. Thank you so much.
Yeah, you're welcome. Yes, Joseph, talk to me.
Okay, sir. So my question is, since this course is newly introduced,
yes,
I wouldn't know if we can have access to past questions.
That's not a problem.
Because,
yes, go ahead.
Because past questions also will guide us maybe after we are done with the lectures, we can lay hand on them and then look at how to solve them.
That's not a problem. You are going to, you see all of, in the question, there are so many questions here in the material. You see them later on, not now.
Okay,
You know,
okay,
financial
sir.
management is universal, even though the examiner is just introducing it into the syllabus. So
Okay,
it's universal. So that's no problem. You get the questions later on. All right?
okay, okay. Thank
Yes,
you, sir.
you're welcome. Tolu, talk to me.
All right, sir. So I just want to have I'm seeking clarity so I can gain proper perspective. So
Okay.
in nutshell, what are we trying to achieve when we say we are taking into consideration the cost of capital? Or maybe when someone's working in an organization and you have something, what's relevance does cost of capital bring to the table?
Mm, okay. You know, I mentioned to you earlier, maybe you have not joined when I was explaining the importance, the significance of cost of capital. I mentioned to you that cost of capital is used for determining debt equity proportion, and it's also used for project evaluation. Say, for example, in practice, say you want to carry out investments, okay, you have found an investment opportunity and you want to commit your financial resources on the project. You can't just say because, oh, you have identified one investment opportunity and you want to put your money on it. No, it is essential that you will evaluate and determine the financial viability of the project before you commit your funds into executing the project. So, without cost of capital, you will not be able to evaluate the project. That's one of the significance of cost of capital. When you want to evaluate a project, you are going to need cost of capital. It is that I think you did, maybe you did performance management last diet or previously. You might have calculated net present value, isn't it, Tolu?
Yes, sir. Yes, sir.
So when you are calculating NPV, you are given cost of capital in that particular question. But how do you arrive at the cost? Without the cost of capital, you will not be able to discount your future cash flow. You know, you multiply cash flow with the discount factor, isn't it, to get your present value, right? So without the cost of capital, you will not be able to do that. So that's one of the importance of cost in practice. That's how it works. You can't just commit your money into projects without evaluating it. That would be very disastrous or catastrophic for any company to do, to just invest so much huge sum of money without evaluating the investment. What if the capital is eroded? That would be a loss of investments, and you have to guide against that. All right? Is it clear now?
Yeah. So just one more thing, sir. So it says
Talk to
that
me.
the calculation of cost of capital is not the end of the road itself.
No, no.
Okay.
You
But
can use cost of capital in several, like I mentioned earlier today. Cost of capital is fundamental, is foundational in financial management. As we proceed, as we go along in the diet, you are going to see where we are going to be using it. Under business valuation, you would need cost of capital. Under capital structure, you need cost of capital. Under dividend value, under the dividend, there's no topic you want to do in financial management that you are not going to need cost of capital.
okay. I think
And that's why pardon?
I have a better perspective now.
Yeah. So and that's why it is important for you to know how to estimate it. You know, when you did under performance management, when you did capital budgeting, you are just given the cost of capital. You don't know how they arrive at the cost of capital. So how to calculate those cost of capital is what we are treating now.
Okay.
Okay? Yeah.
Yes, sir. Okay.
All right. So any other question? Any other question for me so that we can close the class? Yeah, somebody is asking whether I will share the material. Yes, I will share the material later on. But the notes I jotted down, I will share that one almost immediately. Okay, so in the absence of no further question, this is where we are going to call it a day. By the grace of God, we are going to meet next weekend. But Mr. Ashiwaju will be taking you. I think the next FM class is on, was it Tuesday or Wednesday? From the timetable.
Wednesday.
Wednesday. Okay, so Mr. Ashiwaju will be taking that class on Wednesday. All right. So thank you guys for your time and patience. I will see you next weekend by the grace of God. Bye-bye, everyone.
Thank you, sir. Bye.
Thank you, sir. Thank you, sir.
Thank you, sir.
You are welcome.
Thank you. Bye. Good night, sir.
Night, sir.
Good night, everyone.